Hello everybody, I'm Tom Dorsey, President of Dorsey, Wright Associates. It's the 1st of March, 2013. Today is a birthday, as a matter of fact. 6 years ago, our PDP, which is our Technical Leaders Index of U.S. equity stocks, came to market. It's the first technical analysis ETF that ever came. I've been working with ETFs since the 1980s. We're one of the first people on the planet to be involved with ETFs. Well, our own ETF now, the performance has been fantastic. Over the last 6 years, that takes you through the crash of 2008. Our PDP is up 26.5%, while the Standard & Poor's is up 7.9%. That's big outperformance, and you want to think about this when you're looking at portfolios. Consider the PDP, or at least if you're using the SPX or the RSP, which is the equal-weighted Standard & Poor's 500, combine the PDP with it. Add the alpha to your position. Now, something interesting happening, too. If you look at a normal distribution, I take you back to Statistics 101 in college. The bond market has just been crashed. Interest rates have been going up, bonds significantly down. But what's happened is we have regressed back to mean. So you come from the trend has been down, and we've regressed back to the middle of the bell curve, which is perfectly normal. On the other side of the coin, the stock market had gotten extremely overbought. Almost all the stocks in the Standard & Poor's 500, when you look at each one of their individual bell curves, are skewed to the right-hand side on the aggregate picture. It's now shifting back more toward the middle. And that's exactly what you would expect to happen. However, it's telling us something. Whenever you get a regression back to mean, it's a regression back to the mean of the trend. The trend in bonds is still down. Interest rates are still rising. U.S. equity markets trends are still up. So expect the market to pull back to the center. It's doing what it's supposed to do, but then I think it's going to catch a wheel again and move forward. The bond market is a different thing. We're seeing breakouts in interest rates themselves, not the bonds, and that's a negative thing for the bond market. The future doesn't announce itself. It comes. And if you look at the bond market in Greece, everything was fine until about 5 days before it collapsed. I'm not saying the bond market's going to collapse here, but probably the next crisis that we're going to be in will ultimately be the bond market. Whether it's next week, next year, next 5 years, it's the one thing that definitely has a bubble out there. So that's all we'll have to say today. We'll talk to you about the DWA Minute next week.